Did you know that Warren Buffett just sold over $75 billion in stocks? What can this move teach us about the current market? Let's find out. Warren Buffett has just sold over $75 billion of his stocks, including a good portion of Apple, which is one of his biggest bets. Now, he has more cash than ever, with Berkshire Hathaway holding $177 billion in cash. In the last 2 years, this cash amount has only grown, and the latest report shows it is significantly larger than anything we've seen in the last 30 years. He had $189 billion, so it was quite a leap. In this video, we will investigate if this information makes sense and what this record cash reserve says about how Buffett views the economy and the markets. Looking back to 2007, Buffett also had a lot of cash saved. Just on the eve of the global financial crisis, when the US stock market plummeted by 60%, he then began investing this cash into new opportunities when stocks were cheaper in 2009 and 2010. This made it seem like he had insight into what was going to happen that others did not. By the end of 2021, Warren Buffett had a lot of cash saved up, well before the stock market hit its peak and then fell by 20%. He used this opportunity to invest in new ventures. However, the chart showing Berkshire Hathaway's cash allocation can be somewhat misleading. You can't just look at the total cash. We need to see it in relation to the size of the investments he has, because Berkshire's portfolio today is not the same as it was in the 90s. So, it is normal to see an increase in cash as the company grew. This doesn't mean that the cash allocation is high. Let's take a closer look at this. The chart shows Berkshire's cash allocation as a percentage of total assets. Indeed, we can see that Buffett significantly increased the cash amount last year compared to total assets. We can confidently say that he has never had such a high cash allocation. But the last time the allocation was at similar levels was in January 2006, almost 2 years before the Great Recession. During that time leading up to the start of the recession, the percentage of cash Buffett had was actually decreasing relative to his assets. This means he was increasing his stock positions in the 2 years before the financial crisis. It doesn't seem to indicate that he was aware of any problems in the banking system or had any insider information about a potential market collapse. If he knew that the crisis was going to happen, his chart would show something different. Another thing worth noting is that Warren Buffett had very little cash saved in 2000, well before the US stock market fell by 50% due to the 2001 recession. If he really knew the recession was coming, he would have kept more cash on hand. Buffett has never claimed that he can predict markets. He has always made it clear that he does not make investment decisions based on economic forecasts, and even joked that any company hiring an economist as one employee too many. In other words, Warren Buffett is not increasing his cash reserves because he thinks some economic disaster is coming. He is holding more cash because he doesn't see good investment opportunities in the market right now. In other words, he feels that stocks are too expensive. One of the indicators he likes to use is now at its highest level since 1947. This indicator is known as the Buffett indicator, because he said it's a simple way to measure whether the stock market is expensive or not. It is calculated by dividing the market value of stocks by the US GDP, basically showing how expensive the market is relative to the size of the real economy. Today, this indicator shows that the market is more expensive than ever, which makes it even harder for investors like Buffett to find good opportunities. This is because Warren Buffett is a value investor. His philosophy is quite simple: buy great companies at affordable prices. This idea comes from his mentor, Benjamin Graham, who wrote The Intelligent Investor. In the book, Graham states that the stock market will swing between being very expensive, when investors become overly optimistic, and very cheap, when fear takes hold. He emphasizes that being a smart investor allows one to take advantage of a cheap market to buy good companies at good prices. And when the market is expensive, the smart investor should increase cash reserves and wait for better opportunities, especially if the return on cash is greater than the yield on stocks. Currently, the yield on cash is around 5% due to the increase in interest rates by central banks. Meanwhile, the yield on earnings from the S&P 500 is around 3.6%. In Graham's book, he says that this is exactly the type of scenario where the smart investor should increase cash reserves to achieve good long-term returns. However, as we discussed throughout the video, we cannot claim that this strategy will predict the next major movement in the stock market in advance. Did you enjoy the content? Don't forget to like, subscribe to the channel, and share your opinions in the comments. What do you think of Buffett's strategy? Let's talk.